A few years ago, a friend of mine living in Richmond Hill, Ontario, told me that he had invested in a balanced mutual fund from a Canadian bank for over 10 years. He didn't lose any money, but the funds hardly grew over the 10-year period. His conclusion was that balanced fund is probably too balanced. Larry Bates, author of the book Being a Bank, shared a very similar story where his sister Mary invested in Scotia mutual funds for over 20 years. Her retirement nest egg only grew a little bit despite how well the market had performed. So how is this possible? Don't we have the history's longest bull market with record highs? Let me know in the comment section below if any of you or your loved ones share a similar experience or outcome. This is the diagram wealth formula. The left side are the wealth builders, namely the amount of money, time invested, and rate of return that you achieve. They're your best friend, and you need to maximize them whenever possible. The other side are the wealth killers, fees, taxes, and inflation. For the purpose of this video, I will assume investment is held in tax shelter accounts and no significant change in inflation. That leaves us with just one wealth killer to tackle, fees. So exactly how much do we pay in fees of our investment life if we had invested in actively managed mutual funds promoted by the big banks? Let's assume you're a 35-year-old average investor. With the help of your trusted financial advisor, you have determined that your risk tolerance is medium, and he recommends a balanced mutual fund. You decide to take his advice and invest $10,000 in a mutual fund. Let's fast forward 30 years, where the market delivers 5% return on average. If you capture all of the market returns, you would expect your portfolio to be worth $43,219. However, you notice that your investment only grew to $24,272. The gain on the market returns $33,219 in comparison to your gain of $14,272. What happened there? Well, it's because this balanced mutual fund has a management expense ratio of 2%, which means 2% of your total value is extracted as fees to the banks and advisors every single year. Such a large difference between the market return and your return is due to the magic effect of compounding. In this case, compounding cost against you. Do you find the following list of mutual funds familiar? Do you own any of them? In fact, the 2015 Global Fund Investor Experience Study by Morningstar ranked Canada as the absolute worst among 25 countries in terms of high mutual fund fees. Yikes! But wait a sec. Don't you only buy good mutual funds with great past performance, therefore are likely to outperform the market in the future? It is very important to understand that past performance is not an indicator for future performance, and the only thing that matters to an investor is the future return. Countless studies overwhelmingly conclude that mutual funds underperform the market average in the long run due to their fees. In fact, many fund managers now accept the fact that they cannot consistently beat the market. Instead, they quietly mimic the index and charge a huge fee. So how do the banks manage to keep selling Canadians in the expensive mutual funds? Maybe that's how parents invested before, and we just copy our parents. Or that's how friends and family invest today, and we don't want to be different. Very few Canadians truly understand the amount of fees they're paying. In addition, banks have a big army of advisors that employ a proven four-step system. The pitch. Most Canadians know that they need to save and invest, but often feel overwhelmed and fearful doing it. The banks capitalize on this insecurity with their marketing machine, bombarding Canadians with a smokescreen of complexity, bewilderment, and false salvation. Remember BMOS, we are here to help advertisement? Most institutions and advisors will provide you with a free financial plan. Some advisors will even be happy to come to your home to discuss the details of the plan and no fees. Why would they go out of their way to provide this valuable planning service at no cost? Are they just too nice? The truth is that it's merely a sales pitch, knowing that a significant percentage of Canadians will feel an obligation to buy the products after receiving the planning services. The sales rep would then promote the high-fee products as much safer and better performing investments by citing benefits such as diversification and reduced risks. The only thing they don't talk to you are the fees. Some examples are mutual funds, principal protected notes, and various insurance products. Next, well, you guessed it, you are the prize. With true fees of 50% or more, the big banks raking above $24 billion annually from Canadian investors. So are you ready to return on you think? If you can't trust the banks with your investments, what should you do then? The first step is to learn the investment basics. It will empower you to make better investment choices and potentially double your investment return. Be a long-term investor and think like a business owner. The market can be very volatile with daily prediction of market boom and market crash. Ignore all the noises and write down the short-term highs and lows on the market. Minimize the cost. Find the fees, reduce the fees, rinse and repeat. Okay, now you got those 3 points down pat, but how do you actually execute it? You ask yourself, are you an average investor? Do you want benefits of diversified low-cost index funds, but also prefer ongoing support in determining the right mix of different asset classes that is right for you? And the answer is yes, then robo-advisor is right for you. This allows you to keep between 70 to 90% of the potential return. Don't forget to automate the investment process. This approach will require zero annual maintenance by you. You say you want more? Let's say 95%? It's actually not hard. You just have to be willing to open an online discount brokerage and purchase a small number of broad index ETFs by yourself. What's an ETF, you may ask? You can think of it as a mutual fund with extremely low fees. If this sounds good to you, then you are AIY investor. This is also known as a couch potato investing. A great place to find out ETF information is Canadian Couch Potato website. But what if you say you want 100% and leave nothing from the banks? In that case, you have to be a DIY investor. You do research and buy individual securities yourself. Just make sure you do enough research and have a deep understanding on individual securities you wish to purchase. The author suggests to start from the blue chip companies before venturing into other more speculative stocks. A notable recommendation in the book is to buy Canadian banks. Why, you may ask? Well, they are all rock-solid business with perfect record of growing revenue and increasing dividends over the last century. They're also protected by the government as foreign bank competition is severely restricted. Canada has a positive economic outlook and Canadians actually love the banks. Of course they do. Otherwise, how can the banks make so much in fees? In conclusion, if you want to be in a bank, be a banker.